The AI Advantage by Tim H. Safransky is the definitive playbook for real estate entrepreneurs who refuse to get left behind. Not theory, not hype, but proven AI strategies for deal analysis, underwriting, and business decisions that are separating winners from losers right now. Today, we're breaking down his framework, the exact tools top investors are using to analyze more deals, underwrite faster, and make better decisions while their competitors are still stuck in spreadsheets. Most real estate pros have no idea this technology exists. Let's fix that. Act 1. The Real Estate AI Revolution. Chapter 1. The Deal Flow Problem. Marcus owns a small multifamily portfolio in Phoenix, 3 properties, decent cash flow. But he's stuck. Every week, brokers send him 50 new listings. His goal is to buy 2 more buildings this year. But here's the problem. To find those 2 deals, he needs to analyze all 50. Every single week. That's 2,600 properties per year to find 2 winners. The math is brutal. Each deal takes him 3 hours to underwrite properly. Rent comps, expense analysis, cash flow projections, exit scenarios. That's 150 hours per week. Impossible. So Marcus does what everyone does. He skips most deals, glances at the broker package, makes gut calls, and wonders why he keeps missing opportunities. Then he discovered AI, not to replace his underwriting, but to handle the first pass. He built a simple workflow. AI pulls rent comps from multiple sources in 30 seconds. AI analyzes expense ratios against comparable properties. AI runs cash flow scenarios across 5 different cap rates. AI flags deals worth a deeper look. Suddenly, Marcus's 3-hour underwriting dropped to 20 minutes, but only for the deals that passed AI's initial filter. The result? He's now analyzing 40 deals per week instead of 3. He's seeing patterns he never noticed before. And last quarter, he closed on 2 properties his competitors passed on because they didn't have time to look. This is happening right now, not in 5 years. Today. And the gap between investors using AI and investors ignoring it is exploding. Here's what Safransky makes clear. Real estate is an information game. Whoever analyzes more, deals better, and faster wins. For decades, that meant hiring bigger teams. More analysts, more overhead, not anymore. I just made a single investor as powerful as a team of 10, but only if you use it. The broker's sending you deals. They're sending them to 200 other investors too. The MLS listings, everyone sees them. Your edge isn't access anymore. It's speed and accuracy. And right now, while you're manually building spreadsheets, someone is using AI to analyze 10 times more deals than you. They're finding the opportunities you're missing. Not because they're smarter, because they're faster. So ask yourself this. How many deals did you pass on last month simply because you didn't have time to look? How many spreadsheets are sitting in your email right now that you meant to analyze but never did? Because every one of those is a missed opportunity, and your competitors using AI aren't missing any of them. Chapter 2. The Underwriting Trap. When Sarah started investing in commercial real estate, she bought a course on underwriting. She learned the IRR formulas, the waterfall structures, the sensitivity analysis. She built a beautiful Excel model with 47 tabs. It was perfect. Except it took her 6 hours to underwrite a single deal. And by the time she finished, the property was already under contract with someone else. This is the underwriting trap. The better you get at traditional analysis, the slower you become. More detail, more precision, more tabs, more time. And in a competitive market, slow means dead. Safransky calls this the complexity curse. You're not wrong to be thorough, but thorough without speed is just expensive hesitation. The traditional model is broken. You're doing work that doesn't scale. Every deal starts from scratch. Copy the template, update the assumptions, build the rent roll, import the expenses, run the scenarios, rinse and repeat. It's 2024, and you're still doing arithmetic that a machine could handle in seconds. That's not sophistication, that's waste. Here's the shift AI enables. You stop doing calculations and start making decisions. AI handles the data entry, the formula building, the scenario modeling. You handle the judgment. Is this neighborhood trending up or down? Will this renovation actually get those rents? Is the seller's expense ratio believable? These are questions that require experience and intuition. Everything else is just math. Safransky shares a case study of a syndicator named James. James was raising capital for deals, but his underwriting process was killing him. Investors asked for sensitivity analyses, different return scenarios, stress testing. Each request meant hours of spreadsheet work. Then he integrated AI into his workflow. AI generates full underwriting models from property data in 90 seconds. AI runs 20 different scenarios simultaneously. AI produces investor-ready reports with charts and tables. What changed? James went from underwriting 2 deals per week to 15. His investor decks went from basic to institutional quality. And his close rate jumped because he could respond to investor questions instantly. No more, let me run those numbers and get back to you. The AI had already run them, all of them. But here's what most people miss. AI doesn't make you less analytical. It makes you more analytical. Because when AI handles the grunt work, you can actually think. You can compare across deals, spot market trends, test unconventional strategies. The analysis gets deeper, not shallower. You just stop wasting time on work a machine does better. The investors winning right now aren't the ones with the most complex models. They're the ones with the fastest time from listing to offer. And that speed comes from AI. So here's your question. Are you still proud of your 47-tab spreadsheet? Because while you're updating it, someone else already made the offer. Chapter 3. Decision fatigue is killing your returns. Ryan analyzes industrial properties in the Midwest. Good investor, sharp numbers, but he has a problem he didn't recognize until Safransky pointed it out. Decision fatigue. By property number 8 each week, Ryan's judgment deteriorates. He misses red flags. He gets optimistic about bad deals. He gets pessimistic about good ones. Not because he's bad at analysis, because his brain is exhausted. This is the hidden cost of manual underwriting. It's not just slow, it's cognitively draining. Every cap rate calculation, every rent comp search, every expense assumption. Each one requires a micro-decision. And after 50 micro-decisions, your decision-making quality drops off a cliff. Safransky's research shows that investors make measurably worse decisions on the 5th deal of the day compared to the first. Same investor, same skill, worse outcomes. AI solves this, not by making decisions for you, but by eliminating the decisions that don't matter. You don't need to decide which comps to pull. AI pulls all of them. You don't need to decide which scenario to model. AI models all of them. You don't need to decide how to structure the analysis. AI structures it consistently every time. Your brain saves its energy for the decisions that actually drive returns. Safransky tells the story of an investor named Priya who tracks this religiously. Before AI, she analyzed an average of 4.2 deals per week. Her acquisition rate was 1.8%. After implementing AI, she analyzed 18.7 deals per week. Her acquisition rate jumped to 3.4%. That's not just more volume, that's better selectivity. She's seeing more deals and choosing better ones because she's not mentally exhausted by the process. Here's the pattern. Manual analysis creates a false trade-off. You can either be thorough or be fast. AI eliminates that trade-off. You can be thorough and fast. You can analyze every deal that crosses your desk without burning out. You can maintain the same level of rigor on deal 20 that you had on deal 1. That consistency compounds into better portfolio performance. But most investors never make this shift because they think their exhaustion is normal. They think real estate is supposed to be grinding. They wear their 60-hour weeks like a badge of honor. Meanwhile, investors using AI are working 30 hours and doing twice the volume with better returns. Not because they're working harder, because they're not wasting cognitive energy on tasks machines handle better. So track this for yourself. How sharp is your analysis on Friday afternoon compared to Monday morning? How many deals do you skip at the end of the week simply because you're tired? Because that's not dedication. That's leaving money on the table. And I just picked it up. Act 2. The AI Toolkit for Real Estate. Chapter 4. Rent Comp Analysis in 30 Seconds. Traditional rent comp analysis is medieval. You open Rentometer, then Zillow, then Apartments.com, then the MLS if you have access. You manually copy data into a spreadsheet. You try to adjust for differences in unit mix, condition, amenities. You make educated guesses. The whole process takes 45 minutes, and you're still not confident in the numbers. Safransky's first AI implementation is always rent comps. Because it's high impact and easy to prove, here's how it works. You feed AI the property address and unit mix. AI simultaneously queries multiple data sources: Rentometer, Zillow, Apartments.com, CoStar if you have it, local MLS data if integrated. AI pulls every comparable property within your specified radius. AI adjusts for unit size, amenities, condition, and lease terms. AI generates a confidence-weighted average. 30 seconds. Done. But here's where it gets powerful. AI doesn't just give you a number, the range. It shows you the distribution. Is this market tightening or loosening? Are rents accelerating or decelerating? What's the variance between Class A and Class B? You're not getting a comp. You're getting market intelligence, and that changes your underwriting completely. Safransky shares the example of an investor named Derek. Derek was underwriting a 24-unit building in Nashville. Traditional comps showed $1,450 per month for two-bed units. He was conservative, used $1,400 in his model. The deal barely worked. Then he ran AI comps. The AI found that properties with in-unit washers were getting $1,625. Properties without were getting $1,300 to $75. Derek's building had washers. He was underwriting it as if it didn't. That one insight changed the entire deal. His actual achievable rent was $1,600 to $25, not $1,400. That's $200 to $25 per unit per month. Times 16 two-bedroom units. That's $3,600 per month, $43,200 per year. Capitalized at a 6% cap rate. That's $720,000 in additional value he almost missed. Not because he was lazy, because manual comp analysis doesn't catch these nuances at scale. Here's the key. AI doesn't replace your judgment about market direction. It gives you better data to inform that judgment. You still decide if you believe those rents are sustainable. You still factor in your competitive advantage or disadvantage. But you're making those decisions with comprehensive data, not guesswork. And in real estate, better data means better returns. The investors still doing manual rent comps are operating with partial information. They don't even know what they don't know. And that asymmetry is costing them millions in missed value and overpaid acquisitions. So stop treating rent analysis like a research project. It's a data problem. And I solved it. Chapter 5. Expense Ratio Reality Check. Every seller's broker package shows expenses that are too low, always. It's not fraud. It's optimism. The seller didn't include the roof repair. They self-manage, so management fees aren't there. They have a buddy who does maintenance cheap. And you, the buyer, are supposed to figure out what the real expenses will be. Most investors use rules of thumb: 50% expense ratio for small multifamily, 40% for larger properties, 35% for Class A. But those are national averages. They don't account for your market, your property type, your management structure. And using the wrong expense assumption can turn a good deal into a disaster or a disaster into a pass when you should buy. Safransky's approach is surgical. AI analyzes actual expense ratios from comparable properties, not averages from the internet. Actual operating statements from properties you've acquired or that are in your market. AI breaks it down by category: property tax, insurance, repairs and maintenance, utilities, management, landscaping, snow removal, everything. I shows you what properties like this actually cost to operate. Here's a real example. An investor named Lisa was underwriting a 32-unit building in Milwaukee. The broker showed $4,200 per unit in expenses. Lisa's rule of thumb suggested $5,100. She used $5,400 to be conservative. The AI analysis showed comparable properties in that submarket were running $6,200 per unit. Why? Heating costs in that specific neighborhood were 40% higher due to older heating systems and building orientation. If Lisa had used the broker's number, she would have overpaid by $300,000. If she'd used her conservative estimate, she still would have overpaid by $170,000. The AI caught a market-specific reality that rules of thumb miss, and it caught it in 45 seconds. That's not just better underwriting. That's money saved. Real money. The kind that shows up in your actual returns 5 years from now. But expense analysis is where most investors get lazy. They don't want to dig through operating statements. They don't have access to comparable data. So they guess. And in real estate, every guess compounds. A 5% error in expense assumptions doesn't cost you 5% of the purchase price. It costs you 5% of your annual NOI, capitalized forever. That's hundreds of thousands of dollars in enterprise value. AI removes the guessing. You're not using national averages anymore. You're using actual data from actual properties in your actual market. And the investors doing this are underwriting deals that pencil, where others see only marginal returns, not because they're finding better deals, because they're analyzing them correctly. So ask yourself, do you really know what your properties cost to operate? Or are you using numbers that make the deal work? Because if it's the latter, your returns are already broken. You just don't know it yet. Chapter 6. Scenario Modeling. That actually helps. Traditional scenario analysis is a joke. You run 3 cases: best base and worst. Best case assumes everything goes right. Worst case assumes everything goes wrong. Base case is your actual underwriting, and then you make your decision based on what exactly. Whether you can stomach the worst case, this tells you nothing. Safransky's framework is completely different. AI runs hundreds of scenarios simultaneously, not best, base, worst, but probable distributions. What happens if rent growth is 2% instead of 4%? What if vacancy hits 8% in year 2? What if interest rates rise and your refi doesn't work? What if CapEx is 30% higher than projected? It doesn't show you 3 outcomes. It shows you the probability distribution of outcomes. This changes everything, because now you're not asking, what's the worst case? You're asking, what's the probability I achieve my target return? And that's an answerable question. I might tell you there's a 68% chance this deal returns between 14 to 18% IRR, a 15% chance it returns below 12%, and a 3% chance you lose money. That's decision-useful information. Here's a case study. An investor named Carlos was comparing 2 deals, Deal A showed a 16% IRR in his base case. Deal B showed 14%. Traditional analysis says buy deal A, but when Carlos ran AI scenario modeling, the picture flipped. Deal A had huge variance. In 30% of scenarios, it returned below 10%. In 15% of scenarios, it was break-even or worse. Deal B was tighter. In 75% of scenarios, it returned between 13 to 16%. Almost no downside scenarios. Carlos chose Deal B, not because it had higher returns, because it had more reliable returns. And 3 years later, Deal B is tracking at 15.2% IRR, while investors who bought comparable properties to Deal A are struggling with unexpected capex and slower rent growth. Carlos didn't get lucky. He ran better scenarios. This is where AI separates operators from speculators. Speculators chase the highest IRR on paper. Operators chase the highest probability-weighted return. And probability weighting requires modeling hundreds of scenarios, which requires AI, because you're not doing that in Excel without losing your mind. But here's the trap most investors fall into. They run scenarios and then ignore them. They see the range of outcomes and still make decisions based on the base case. That's not scenario analysis. That's scenario theater. Real scenario analysis changes which deals you buy and at what price. If you're not willing to adjust your offer based on downside risk, why are you modeling it? The investors winning aren't the ones taking the most risk. They're the ones quantifying risk accurately and getting paid appropriately for it. And that quantification comes from AI-powered scenario modeling. So stop pretending 3 cases in Excel is analysis. It's not. It's guessing with extra steps. Act 3. The AI Decision Framework. Chapter 7. Market Analysis at Scale. Jason invests in secondary markets. Boise, Spokane, Des Moines, Greenville. His thesis is simple. Buy in growth markets before they're obvious. The problem? How do you identify those markets without spending 6 months researching each one? Traditional analysis means reading reports, tracking employment data, monitoring permits, following local news. It's slow, manual, and impossible to do for 50 markets simultaneously. Safransky's solution is AI-powered market surveillance. You define your investment criteria: population growth above 1.5%, job growth above national average, household formation increasing, housing permits below demand, rent growth accelerating. AI monitors every market in the country against those criteria daily. And when a market meets your thresholds, AI flags it. But it goes deeper. AI doesn't just flag markets, it explains why. Population growth is driven by corporate relocations, not just Sunbelt migration. Job growth is concentrated in high-wage sectors, not just service jobs. Rent growth is outpacing income growth, signaling potential resistance ahead. You're not getting a list of cities. You're getting market intelligence that would take an analyst weeks to compile. Here's what this looks like in practice. An investor named Rachel set up AI market monitoring in January 2023. Her criteria focused on tertiary markets with university expansions or major employer announcements. By March, AI flagged Huntsville, Alabama. Amazon was building a distribution center. Mazda Toyota was expanding. Housing permits were 15% below projected demand. Rachel had never considered Huntsville. She visited, ran the numbers, bought 2 apartment buildings in June 2023. 18 months later, those properties appreciated 22% and rents increased 18%. Not because Rachel got lucky, because AI was scanning 200 markets while she focused on underwriting. She wouldn't have found Huntsville any other way. She didn't even know to look there. This is the power of AI market analysis. You're no longer constrained by your existing knowledge. You're not relying on broker relationships to tell you where to invest. You're systematically identifying opportunities based on data-driven criteria.